I want to get into the current macro times, right? I alluded to it a little bit earlier, but there's been a lot of crazy, things going on. Obviously the massive amounts of QE, the global economy shutting down for multiple months at a time, and the list is almost endless. It seems like these days, but we're kind of in a unique period. So I'm going to leave it a little broad and just ask you, overall, like, how do you view it right now? Because there's kind of, the debate that are we in a recession? Are we not? How this overall strength of the economy and et cetera, et cetera. So I'll leave the floor is yours. I'll leave it a little bit more open-ended, but how do you kind of view the current times right now?
All right. There's a lot to go with here. So first of all, the COVID response from the Fed was unprecedented. And yes, there are a lot of times in my life that I've heard unprecedented. And that's partly because they always ratchet things up a little bit more at certain periods. In 1998, when long-term capital blew up, it was unprecedented that the Fed stepped in with the big banks and bailed them out. We could look back on the great financial crisis and what the Fed's response was with, direct injections into banks. You can look at QE from Ben Bernanke, that just was sort of global in scale. You can look back on the Europeans and the Asian markets, Japan notably, with negative interest rates, which is still puzzling to me as maybe the worst idea ever by a central bank. So we have that. And then, so going back to the COVID response, I think that everybody was just blown away, not knowing what to do. And the Fed could have done less, but they did too much. And everything is in hindsight, of course. But now here we are with a $9 trillion balance sheet. They have the QT occurring right now, which is 100 billion coming off the balance sheet. It's actually 100 million billion million. It's mindless to me when I hear people talk about the Fed getting ready to cut rates. Okay, so you have to think that if they're trying to reduce their balance sheet, that is a form of tightening. If they continue to raise rates, that's a form of tightening. But why would they do one versus the other? It just makes no sense to me. I think the Fed has made a lot of very poor decisions over the years. I joke and say that they're really good at fixing problems that they create, and then what they fix the problem with, they have to redo again and again and again, and go through this cycle of more stimulus, trying to take it off, but not really. So the problem I see right now is that the Fed has become too much of a focus in the market, and the market is trying to tell the Fed, no, we want you to cut rates. They've been pushing down the 2-year and 10-year, and the curve is still rather inverted, and I really believe that the market has it wrong. I think the Fed, in their response for fighting inflation, I think the scary thing is that they're making it up as they go, and they'll say something, and Powell, in my opinion, has done himself no favors by really coming out and we're going to have a hawkish message in the statement, and then essentially reversed it all and was incredibly dovish. He did it it was July or August. I think it was late July that meeting, and to me, it's that constant walking back, where he's giving the market something to hope for, and they rally the market, and then all of a sudden they have to walk it back, and it's just bad messaging, in my opinion. And the Fed, this Fed especially, thinks that they are giving the markets really clear messaging, and they're trying to be upfront and say, this is what you should be expecting. They don't want surprises with the market. But the problem that I see is that the financial conditions are looser today than they were when the Fed started to tighten. And that poses two risks. The first risk is that inflation won't come down as fast as hoped. And that is that's one very likely situation that we're in. The second is, and this is a bigger problem, and I'm not sure if it's going to happen, but I wouldn't put it past anybody right now. The way the markets are reacting is that inflation starts to increase again, and that's not unprecedented. We're going back to unprecedented. The 70s saw several periods, the period of high inflation. They saw dips, and the Fed backed off, and then they had to tighten again. That was with Arthur Burns, and he was, looked back on through history as sort of a failure. And I think Powell's going to be looked back at as a failure as well. And that that's where we are with the Fed and that macro scene. So I got a couple more ideas. The dollar. So we've had like one trade. Either the dollar's going up, rates are going up, commodities are going up, stocks are going down. And we've reversed that with the dollar going down. We've had stocks going up, rates are going lower, commodities are sinking. I'm just writing a report on commodities right now. So I think that could reverse. And it didn't look very good for commodities last Friday. It was just a dreary day. And I think the dollar signal, we actually caught the dollar top pretty well. And now we've been, for the last week and a half, been expecting the dollar to have some sort of reversal. And we'll see how far it goes. But last Friday's move was a pretty good first step to see if that can continue. There's a lot of animal spirits in the market right now. A lot of people in the stock market are buying back stuff that was really beat down over the last year. A lot of garbage. I mean, you can look at Carvana, Bed Bath & Beyond. Those are structurally bankrupt companies. They're, up hundreds of percent. You can look at Tesla as one that is up, 90% off the lows. I think these are just reactionary type bounces, and they'll probably start to fade. So I'll go back to you on you can ask me any questions.